All right, thank you all for coming. My goal today is to create value for everyone. My name's Andrew, and a little bit about me, my background, why am I talking about what I'm going to speak to you about today. I was a mortgage broker, I was a personal banker, stockbroker, and currently my wife and I, we have our own businesses. And so anything I've came across, anything I'm currently in, I want to help others in those areas if I can. And that's the whole goal today, is to create value for you guys. For anyone online, any negative comments, keep it to yourself. It is not welcome here. All right, practical finance. Full disclosure, first two slides are AI, so don't have a heart attack.
It's one of the brightest minds of today. I mean, the level he's on is astonishing. The giving and abundance mindset for others' growth is something we all should strive for. Andrew, his wife Jennifer, and two girls are phenomenal people, and I am blessed to know them while supporting their journey of lifting up others and continual encouragement. I mean, I'm doing a lot of things, but they are incredible. Life is about meaning well and supporting others as much as we can.
Wow, thanks, Elon. Very nice, right? What a generous man. All right, cool. All right, so here's the topics. We're going to kind of go through some, and hopefully within these topics you'll be able to find some value in things you already know. Maybe I can present it a little bit differently. So we're going to start out with inflation. All right, so we're all familiar with inflation. We've heard about it, pretty much know what it is. But how does it really impact us? All right, so if our economy is averaging 3 to 4% over the last couple years, maybe we hit some really high marks, right? Close to 10, above 10%. And then you average it out. How does that impact us and our spending power, our decisions for what we do financially? And the way we're going to take a look at inflation here is, imagine you got cash under your bed. You're just holding actual physical cash, the US dollar, right? Put $100 under your bed. 10 years later, is it worth $100? No, it's not. Probably 70 bucks, right? So, over time, the time value of money due to inflation is things get depleted. Our purchasing power gets depleted. So right now we happen to be in a somewhat decent interest rate environment. The positive in the interest rate environment that we're in is with savings. So saving cash, you can get around 4% right now. If you buy a treasury bill, they're around 4%. So you get that, counteracts inflation, almost like nothing happened. Some people think they're making a lot of money. You're really not. You're just countering what's happening in the economy, our depreciating purchasing power. And so what we can do is, instead of leaving your cash in banks right now are paying like 0.01%, right? And you're like, Andrew, what are you talking about 4%? I'm not getting 4%. Where can I get 4% just with cash? No investment risk. The only risk would be like liquidity risk, credit risk, right? Money market funds, things like that. We'll talk about that a little bit later. Brokerage firms, they offer these investment vehicles where standard banks, right now, they're not going to pay you what they should be paying you. So don't leave your cash under your bed. Don't leave it in a bank that's not paying you what the current interest rate environment is paying out. All right.
Are you taking questions during this, or should I wait?
Let's wait to the end, James. Okay. Unless it's really short. Yeah.
This one's short.
Okay.
If you had 3.3%
Yeah.
I'm curious, what period of time would that be over?
Long term. Long term. Yeah. Because if we look at the past 5 years, it's more like 5% because we had really high rates during COVID. Yeah. So that's 20, 30 years. Yeah. Yeah. Yeah.
That's it.
Okay. Yeah. Thank you very much. All right. Fractional reserve system. Who's heard of it? Okay. Yeah. We've heard of it. All right. So fractional reserve banking is when you take money to the bank, you deposit $100, they're going to loan out a certain amount. Now, the banks used to have a reserve of 10%, right? So that meant if you deposit $100 at the bank, they could loan out 90 of your dollars to someone else. That person takes that $90, deposit at the bank, and then they can lend out 81 or whatever it comes out. And they keep doing this, right? With your original $100. What happened in 2020 is the 10% requirement no longer exists. They are not required to hold any portion of that now. So if you deposit $100 at the bank, they're going to loan out $100. That person that got that $100, they deposit $100, they're going to loan out $100. So it just keeps going, and this should be pretty troubling if you really start looking into it and going, wait, where's this money coming from? Are they just printing this money? Are they pulling it out of thin air? You know, how does this impact me? And so I have an example coming up when we get into the banks that's going to kind of show you some of the issues, but definitely be aware of this as far as if you're trusting in traditional institutions, entities, just know that your $100 isn't there. They've lent it out, and they've lent it out thousands of times. So when you want it back, you just got to make sure not everyone else wants it back at the same time, because you can't get it. There's no amount of money there that they could pay everyone what they owe them. All right, banks. What do we do with banks? Deposit, take a loan for car, house. You can get a CD. CDs, not that good through a bank because they have penalties. Typically, people start out with their investments with CDs and then they need it. They go, oh man, I actually need to pull it out before that 1-year agreement I signed with you guys. And the bank's like, no problem. We expected that. Here's a bunch of fees, and then you're going to get this portion back. And you go, oh man, well that investment didn't work out. So banks have those restrictions. If you're trying to do investments through a bank, the CDs typically have a lot of terms and there are time commitments on them. Not really advised to do. All right, we already talked about the low annual percentage yield you're going to get with your cash at a bank. They're not really paying out much. If you go look online, you can find some weird banks that are like, oh yeah, we don't have any brick and mortars, but we'll pay you like 3.5%. We're all digital. And you're like, I've never heard of that bank before. But any of the ones that you see around the street, the ones that we're currently working with, what are they paying you? 0.01, 0.02%? They should be paying a lot more right now. What they do offer is they have FDIC insurance. That helps in a way that, say the bank goes defunct and you have cash under, it's currently $250K, that the Federal Deposit Insurance Corporation guarantees, right? What's actually a guarantee, right? Are you really going to get it back? Probably. But same thing, if every bank went defunct, FDIC can't pay everyone, right? So that's a little assurance that they give us is like, hey, don't worry, something happens to the bank, we'll cover you up to $250K. All right, you guys know all this already, so I'm gonna move on. Don't leave your cash sit in the bank. I know it's easy to pay your bills, things like that. Just leave a reasonable amount. Don't leave everything there. We talked about inflation. the however much 200K that you have sitting in your checking account, it's not going to be worth 200K. Your buying power is going to be depleted 10, 20 years in the future. So don't leave a ton of cash sitting in a bank. All right, here's a fun one. Silicon Valley Bank. You guys heard about this probably. This happened a couple years ago. All right, so Silicon Valley Bank, popular bank for people in the tech industry. And in the tech industry, there's a lot of startups. They need to have cash ready to go, large amounts of it. So what ended up happening with Silicon Valley Bank, this is a good example of what can happen. This ties into the inflation. This ties into liquidity risk. This ties into credit risk. Silicon Valley Bank, their board, whoever approved it, decided to purchase treasuries at like 0%, right? So their investments as an institution, they didn't go into any type of risk, what they perceived as risk investments. They're like, safe. We can protect our clients by buying US treasuries. The problem was at the time they purchased these treasuries, paying 0.1, very, very small, definitely under 1%. All right, so people started withdrawing cash. They're like, hey, we need our money. Let's get it. Social media, people started posting like, hey, they're giving me a hard time about taking my money out of this bank. What's happening? And all of a sudden, everyone tried to withdraw as much as they could because they heard Silicon Valley banks having a liquidity issue. They don't have the money that you're shown on your statements that you think that you have there. So what ended up happening is they went defunct. FDIC incurred pretty much all the accounts, and they had to start managing this in a way going, well, you're only covered up to 250K. I know you guys are startups and you had 60 million in your checking account for some weird reason, but that's going to be a tough one to pay you back because FDIC covers up 250K, right? All of a sudden, that's a big problem. All right, so Silicon Valley Bank, bad investments. They were forced to sell the treasuries and they lost money on their investments because they were trying to give people what they were trying to withdraw. So they're forced into a position where the treasuries they purchased, they lost a ton of money on every trade because no one wanted those treasury bills, those treasury bonds. Yeah. When they were selling those T-bills and T-bonds, you could go on the secondary market, pick some up for 1, 2, 3% at that time. Theirs were worth 0. So, forced to sell, lost a ton of money. They had to shut down. They closed down completely. They said, you can't take any money out. Everyone's making a run on the bank. So what do? These institutions, they completely shut down. They say no. And they could do that. A lot of people think they can't. They think their money's safe. Same thing in the stock market, the secondary market, is they could just shut down trading. And they do that a lot. All right. So, January 2025, pretty recent, 17 of the executives were sued by the FDIC for a lot of issues, potential fraud, mismanagement. They just did a really poor job, right? So we'll see how that ends up playing out, but hopefully no one had any money at Silicon Valley Bank. And if you did, hopefully it was less than 250K. All right, let's move on to brokerage. All right, so brokerage accounts, Fidelity, Schwab, there's a lot of others out there. What do these institutions do for us? So they're primarily institutions for secondary trading, right? Secondary market, stock market. You can exchange different types of investments, equities, bonds, even CDs, right? So Why buy a CD within a bank when you could buy a CD in a brokerage firm and you could sell it to someone else on the stock market, aka secondary market, and there's no contract for, hey, you have to hold it for a year. No, it's a buyer and a seller. If they're willing to agree on the price, that's what a trade is. And you just trade it, you sell it. All right. So you could do a lot of different investments within the brokerage accounts. This is more so where money grows versus banks. So now we're going to take a look at some of the different elements, brokerage accounts, because they have a lot of different, they have tax deferred, they have taxable accounts, and then they have a lot of different investment options that starts to get a little confusing. So hopefully with my presentation, what I can do is just really start in a way that I'm not going right into the middle of an industry and going, options, all right, who wants to make some money, right? Day trading, let's do option trading, let's trade derivatives. I'll lose you. We gotta start from the ground up to really understand what derivatives are, what options are, what do they really mean, how do we handle them? All right, so 401k, if you have a 401k and you're no longer employed, roll it into an IRA. Just set up an IRA. That's an individual retirement account. Most everyone already knows this. The reason is 401ks, it's a product designed to make it very easy for the average consumer to save, put money into the secondary market and the mutual funds, into ETFs. They have a lot of fees. These 401ks charge you additional fees. So you leave an employer, don't keep your 401k. Roll it into an IRA accounts. IRAs at like Fidelity and Schwab, they don't have any fees. They're not going to nickel and dime you like a 401k will, with an annual fee, with a withdrawal fee, whatever statement fee. There's still a lot of 401k companies that will do that. All right. Cool. So taxable, non-taxable. Taxable is really just a brokerage account. It's something that's not tax deferred. So you place trades. So you're trading equities, securities, whatever you're trading. That event, you can use it as a potential tax deduction if you have a loss. If you have a gain, you can have a short-term or long-term gain, and then it's taxable for that calendar year that you sold that security. Non-taxable accounts, those are the retirement accounts, the tax deferred. With the non-taxable accounts, you could do all the trading you want, right? James is just trading it up in his IRA, going, this is great. I'm making so much money. And you're not going to pay tax unless you take a distribution. So just because you made a profit on a trade in a tax-deferred account, you don't have to pay tax that year, right? It really comes down to when you start taking the withdrawals. All right, so different types of investments. There's some main categories. There's so many types of investments you can get into. But we got stocks. Pretty much what everyone's familiar with is common. Common shares, not preferred shares. Bonds, you could buy bonds from corporations, from the government, from local entities. Your local city may have a plumbing project they're trying to raise money for. You could buy that bond. Typically, they'll try to incentivize you with a higher rate. So if a T-bill, Treasury bill right now is paying 4%, maybe a municipality will pay you 6% to try to incentivize you. Like, hey, will you get a little bit more money with us? All right. They also have cash equivalents. So what's a cash equivalent? There's different investments. The one that you're probably most familiar with would be a money market fund. So MMF, money market fund. What that really is it tries to maintain the value where it's 1 for 1. So you put in $1, you'll get $1 back. What does the fund do? Because it's a fund, the fund will invest in different types of securities. And so what is a money market fund subject to? Subject to liquidity risk, credit risk. So the investments that they buy, credit risk. If they bought a whole bunch of bad bonds, yeah, you could lose your money in the money market fund, because all of a sudden they're like, we just we didn't know what we were doing. We bought a whole bunch of bad funds, and we couldn't really pay you back a dollar for dollar, maybe 70 cents on the dollar, right? So credit risk. Liquidity risk. They have liquidity risk, same thing we talked about earlier. Everyone takes their money out of a money market fund at the same time. Can they pay everyone back? No, they don't have that amount of money. So liquidity risk, if everyone makes a draw, just like a run on the bank, everyone's pulling out of the same money market fund at the same time, you're not going to get your money. Yeah, they're going to have to figure it out. They're going to have to shut it down, figure out what to do. All right, cool. So those are some different types of securities you can invest in brokerage firm. ETFs, mutual funds. We talked a little bit about mutual funds earlier. Those are very common. That's typically what you get offered through your 401k plan. That's a little bit more traditional than an ETF. ETF, exchange traded fund. Those typically will have a little bit less fees. They're a little bit easier to use. And a little bit easier as far as investment side. Pretty much, yeah, there's a lot of things that go into it, but you're seeing those become more and more popular over time. So exchange traded funds, very common. They all have expense ratios when you invest in them. Take a look. Mutual funds, they may have a load fee. ETFs typically will not have any load fee. It's not a mutual fund, but they'll have expense ratios. So actively managed, non-actively managed. If it's actively managed fund, that means there's a fund manager. They're doing a lot more work. They expect to be compensated accordingly. So higher expense ratio. All right. All right. So here's some considerations as far as your investments. The rate that you're going to pay on loans, it's really based on the Fed funds rate, right? Where are they at? So right now, if you're going to get a 30-year traditional mortgage, conventional loan, you're going to pay like 6.8%, somewhere around there. It went down a little bit. If you're going to expect to get some return on your cash, so annual percentage yield, you can expect maybe around 4% or so. Always a good thing to keep track of is what's the Fed fund rate? What are they doing? What's the current interest rate environment? All right, so we already talked about the yield. So yield is what you get back. It's not offered equally amongst all the products. That's where you could find traditional bank. You're not getting what you should be getting. All of a sudden you go into money market fund or buy a T-bill, and you're like, that's a lot more, way more than I would have had otherwise. There's always risk in investing. We all know that. You just kind of invest according to your risk tolerance level. And then one of the most common things that financial advisors will discuss with you when you go, hey, what do I do? I don't know what to do with my money. What should I put it in? What does it look like? They'll ask you, what's your time horizon, right? Where are you at? When are you planning on retiring? What's your risk tolerance? How much risk are you willing to take? And they'll typically say, the younger you are, take more risk. You got time. You could lose it all, but you could make it up again because you're young and you can work. If you're close to retirement, they're like, don't take the risk. Don't get into these really risky investments because if you lose it, you can't make that back up. You don't have the time for that. And most importantly, don't get emotional. We're all emotional beings. So hard not to. Emotions is what gets in the way of making any type of profit in the secondary market because we see the secondary market going down. We panic. We get super emotional. So you got to set a plan ahead of time and you have to stick to the plan. It doesn't matter the swings, the volatility in the market, because markets have cyclical natures. They're very volatile and you can't react to that. If you do, you're toast. So majority of Americans, unfortunately, if they're self-directed traders, they lose money. They don't make money. Very sad. All right, cool. Here's a fun one. Fun little game for us. All right. Assets versus liabilities. Incomes versus expenses. Inflows versus outflows. All right, so by a raise of hands, who thinks a car is an asset? Anybody? Back there? Is a car an asset? Okay. All right. Excellent. Excellent. All right. All right. Yeah, a car is not an asset, right? Because if you just look at this, are you pulling in any money on it? No. You're just, money is flowing out. Cash is flowing out through an automobile. Can you turn it into a cash flow machine? Sure. Yeah, maybe you could do a ride share. Maybe you could do a lending program where all of a sudden the amount you're bringing in is more than what's going out. Then you can consider it an asset, right? All right. House, your personal property. Who thinks personal property is an asset? Okay, cool. All right, cool. So yeah, most people would say, yeah, my personal property is an asset. Robert Kiyosaki would say differently. He would say, no, your house is not an asset because is it pulling any income? Is there any cash flowing in? No, zero flowing in. Everything is flowing out. You're paying expenses after expense. You're paying interest on your mortgage, property tax, homeowners insurance, repairs, maintenance. So it's just cash flowing out. So if you take a look at that principle and you go, okay, all right, well, Andrew, what about the equity? Yeah, there's equity. But as far as any inflow, there is none until you start maybe renting out a room, doing something to bring in some cash flow. And we'll talk about the equity portion. Accessing your equity is one of the biggest issues that I think is most commonly misunderstood. And we tend to go along in our life thinking, oh, I got equity, I'm fine, I'm safe, I'm secure. The problem is the average American, when they want to tap into their equity, it's too late. If you don't plan ahead of time, you're toast. And what happens? It gets taken away from you. People think that can't happen. They think it's not a thing. It happens all the time. All the time. So I'm going to go over different strategies on how to plan accordingly and how to properly view the equity in your personal property. All right. So how do we utilize the assets? Okay. So if you have a personal property, there's a couple things you could do. So I'll give you an example, right? So the economy, something happens, it's terrible, everyone's panicking. Banks will stop lending. They'll get to the point where they'll make their business decisions. They'll stop lending because you're like, oh, I wanted to get refinance. I wanted to get a HELOC. I want to pull equity out. I want to get a second mortgage on my property so I could just use some of the cash. Because you can't use the cash in your house, right? If the real estate market is not going well, there's too much supply and there's really low demand, you can't sell your house. You might think you can, right? But when that time comes, it's too late. No one wants to buy your property. So then what do, right? So here's a couple things you could do to plan ahead of time. Recast or re-amortize. You guys have heard of amortization, right? That's what a conventional loan is. It's amortized over a period of time. 15-year mortgage, 30-year mortgage. Recast it. All right, all that is, it's not a refinance. It's not getting a second mortgage. It's not getting a loan, whatever it is. It's taking your existing debt obligation that you have on your property and respreading it out over a certain period of time. So, Andrew, why would I do that? Why would I want to pay more interest? Because the first half of my 30-year loan is primarily interest. There's no principal. Here's the thing. You work with lenders and more lenders, and these are through traditional banks, right? They're offering these conventional home mortgages. They don't have prepayment penalties, right? That's something you need to look into. If you wanted to pay off your loan quicker, make sure there's no prepayment penalty. A lot of institutions are getting away from that. Recast it, spread your mortgage out back over a 30-year period, and then pay higher. Pay what you were already paying. Don't pay lower. When you recast, respread out your debt obligation, your minimum obligation per month is much lower. But you don't have to just pay that amount. Anything surplus of your minimum monthly obligation goes 100% into principal. So pay 5 times the minimum, 10 times the minimum. Things are going great, whatever it is, pay a lot. Something happens to the economy, you're in a pickle, you're like, I can't afford that. I got fired, and I have 1 month of savings. What do I do? Now you have your minimum obligation is much lower for the most important asset to you guys, your personal property. You can now just pay the minimum. And the difference is significant. It can take a property from $3,500 a month minimum to $500. Doesn't mean you have to pay the $500. What does it cost to recast? Very small amount, very small amount. We're talking just a few $1,000s, maybe a couple $100. All right, so that's a way to self-insure. Things are great when they're going well, but as we all know, we've all been through a lot of experiences, they don't always go well. All right, so recast, reamortize. HELOC, home equity line of credit. You guys have already heard about that. The home equity line of credit allows you to have access to the equity in your house. And so get the HELOC set up before you actually need it. Because when you need it, if it's an economic situation that caused it, well, guess what? Everyone else needs it at the same time. The banks aren't going to lend. They're going to stop. They're going to say, no, everyone wants it. We can't lend everyone right now. And you know what? We just shut down our HELOC department, right? There's a couple banks that did that during COVID. It was horrible. All right. So HELOC, what is it going to do for you? You don't have to touch it. You don't have to use it, but it's there for you. It's an open line of credit based on the equity you have in your property. You can then access that whenever you need to. Typically, it's in 10-year terms. If you let it sit, you never touch it, you don't pay anything except if that institution that lent you that amount has any fees. Good news is a lot of institutions now, they're getting rid of all the upfront fees on HELOCs. So look for those institutions, nothing out of pocket up front. They may just have something like, hey, if you sell your house within a year, pay us $350. That just kind of covers some of our basic costs. Now the interest rate is higher on a HELOC, right? It's going to be higher than a traditional or conventional loan, but having that security and being able to self-insure in a way you can access your equity when you need to, pretty smart, right? Do it ahead of time, don't wait. All right, obviously you want to refinance when we're in a low interest rate environment. Probably most everyone in here has maybe a 3% or sub 3, right? 2.6, anyone 2.2? Okay, all right, yeah. So do that in a low interest rate environment. We talked about inflation earlier. If inflation averages over a 30-year period around 3% or so, and you could refinance your mortgage 2.75%, oh my goodness. Now you have a negative interest rate. You think about inflation, the time that you borrowed that amount of money, the time that you refinanced, and then you take a look 10 years later, all of a sudden, your interest rate is negative, right? So you're actually making a little money on that because you don't have to pay the amount it would be in 10 to 15 years due to inflation, right? That'd be like $500,000 home, $600,000 home, finance it at a lower rate. It stays where you borrowed cheaply. It doesn't increase, right? Inflation always increases. All right, cool. So those are a couple ways to utilize your asset. Yeah, employ some of these. It doesn't really cost you anything. But will it save you? Hopefully. Yeah, and most likely. It'll be there for you when you need it. You don't need it now, but that's when you get it set up. All right, currency. Let's talk about currency, guys. So we got centralized and decentralized currency. So we're pretty much familiar with centralized currency, traditional banking institutions. All right. So if you take a look at any period of time, there's always some form of currency, right? So system of money that's common use within a specific environment over a period of time. Right now, what are we using? Right, we're using the US dollar if you're in America, a couple other things. And so centralized currency, government issued, the US dollar is fiat money. All right, so it's just based on trust, right? Is it based on anything? No, because we went off the gold standard. So it's just kind of going, yeah, the U.S. government's pretty creditworthy. I trust them, I think. And so therefore, I'm going to trust in their fiat money. All right, that's all it's based on. It's just that everyone in society has accepted that and everyone agrees upon that. So that's what we're currently using. Can that change over time? Absolutely. We're already seeing digital currency, which I'll get to. All right, so how do they do their ledger, right? You deposit money, take money out, this, that. The institutions, they have a ledger system. So after the fact, post factum, ledger system, that's what accounts for all the transactions. Those are all through centralized institutions, all right? Regulated institutions. Decentralized, not going through the traditional means, all right? So there's no central authority with decentralized currency that has a post factum ledger system. So decentralized currency goes into virtual currency, all right? Some of us might understand what it is. Maybe we think we do. Maybe we're just like, I don't want to know, no thanks, I'll pass. All right, virtual currency, it's decentralized. It's not centralized. There's no banking institution, there's no government going, oh, we need to regulate that. At least not right now, right? Hopefully that doesn't happen. Non-tangible is virtual, and then it has a certain representation of value. All right, so how are they secured? All right, so cryptography is really how the track record of decentralized currency is kept in check. We've all heard of blockchain, right? So you take a look at the centralized institutions, the currency that's exchanged between, they have a after the fact ledger system for keeping accounts, keeping records. With the digital currency, the virtual, the decentralized, a lot of that, or all of it, is going to be through blockchain. It's not going to be through any specific institution, and then the records can't be altered. So you're going to be able to track it. It accounts for itself. You issue one, that's on the record. It tracks it ever since it's been issued or created or mined or however it comes about. All right, so if you wanted to trade virtual currency and you go, you know what, that sounds good, man. I've been hearing a lot about Bitcoin, Ether. How do I trade that? Well, there's some brokerage firms getting into that space. They're going to charge you a lot of fees right now to trade virtual currency. And so the fees that they're charging is just outrageous. And you could only maybe trade one or two. It's like Bitcoin or Ether, and that's it. So if you wanted to trade some virtual currency, Coinbase, Binance, these institutions, they have thousands of different virtual currencies. Most of them are meme coins, which is an absolute joke, right? You guys have heard it in the news. You can maybe make some money if you time it right, but that's the same thing as like penny stock trading or day trading and trying to time the market, which trying to time the market never works. All right, cool. So, virtual currency. All right, guys. So hopefully this was slightly informative. Hopefully it was helpful in a way. I'll be open for questions, and I didn't make any recommendations. I didn't really say you need to go do this, you need to go do that. I recommend this, I recommend that. I didn't throw any ticker symbols out there. I worked in the industry, so I don't want you guys to hate me. I'm not recommending you do anything. I just hopefully you could take some info, whatever was relevant to you, and I'll be happy to elaborate and fill in any questions that you guys have.